Hi, it's Paddy Hirsch at Marketplace. Today I want to talk about the decision by the Federal Reserve to stop buying mortgage-backed securities created by Fannie Mae and Freddie Mac, and why this is important for individual homeowners, because there is a concern that now that the Fed has decided to stop buying those securities, that interest rates on home loans may rise. Now, a lot of people have written to us and have asked us to explain how this works. In fact, there are people here at Marketplace who have asked us to explain how this works. So let me see if I can give it a shot here. So I'm going to use a little bit of an analogy. And I'm going to use the analogy of a car factory. Okay, so here's our car factory. And it's F&F's car factory, cars. Okay, big door. And let's meet our characters. Here's Fannie, here she is. And here is Freddie. There he is. Big smile. He's got a nice t-shirt on today. There he is. And a nice pair of shorts. There he is. So Fannie and Freddie make cars. Okay, and what they do in order to make the car, they need a raw material. Okay, so the raw material they use is steel. All right, they use lots and lots of rolled steel. And the place they get the rolled steel from is from the steel manufacturer. Okay. And okay, Mr. Steel, the steel maker. Okay, here he is with his hat on. Very jolly chap. He provides steel to Fannie and Freddie. So he provides the steel goes into the factory. There's some kind of magic goes on inside, and they produce cars. Okay, here's our car. There we go. It's a bit of a Model T looking thing, but people are quite popular these days. All right, so that's how the cars are made. You can see. They go to the steel manufacturer, they get the steel, they buy it, through some alchemy, they produce the end result, which is the car, the end product, which is the car. Okay, and how's the economy of this work? Well, of course, there are buyers for the car. Here they are. And the more buyers there are, okay, the more demand there is for the cars, of course, the more steel Fannie and Freddie are going to need from our steel maker, Mr. Steel. Okay, so they're going to need, with rising demand for cars, there is then rising demand for steel. Okay, and if there's falling demand for cars, okay, if fewer people decide to buy cars because the economy is bad or for whatever reason, then the demand for steel is going to fall off. Okay, it's going to drop. Okay, so what does this have anything to do with mortgage rates and all the rest of it, and mortgage-backed securities and stuff? Okay, well, let's just change the details a little bit. Instead of making cars now, Fannie and Freddie are making mortgage-backed securities, which is what in fact they do make. Now, mortgage-backed securities are called vehicles, happily enough. So it's kind of like a car, but it's very, very complex. Okay, but instead of the raw material that they need being steel, actually the raw material that they need are in fact home loans. Okay, they need lots and lots of home loans to create or to make into these vehicles, these mortgage-backed securities. And where do they get home loans from? They get them from the banks. Okay, so Mr. Steel is the banker, or Mr. Steel, the steel manufacturer, is now Mr. Steel, the banker. Okay, there he is. And the same rules apply with regard to supply and demand, okay? Fannie and Freddie, when they make these mortgage-backed securities in their factory, they need to have end buyers, okay? They need to have end buyers for the bonds or the securities that they produce. Okay, here they are, lots of securities. And the more buyers that there are for the securities, the more demand there is for the raw material, not steel in this case, but loans. So they're going to be asking the bank for many more loans, okay? Now, what happened was, when the credit crisis hit, and the financial crisis hit, suddenly the market for Fannie and Freddie's securities dried up, okay? And just as if it was demand for cars, the demand for the raw material for home loans then dried up as well, or there was a danger that it was going to. So because Fannie and Freddie weren't able to sell these securities on, they were then going to have to turn around and say, hey, sorry, Mr. Steel, the banker, we don't need any more home loans, okay? Now, if that had happened, okay, what would have occurred is then Mr. Steel would have to go to Americans, ordinary Americans who want loans, and he would have had to say, hey, look, I'm sorry, guys, Fannie and Freddie doesn't want any more loans, okay, so I'm not going to be able to issue as many loans because I can't sell them on, okay? But lots and lots of Americans clamoring, lots and lots of demand for loans, give us loans, give us loans, give us loans, and the bank is like, you know, if I give you loans, I've only got a limited ability to give you loans or to make loans, so it's going to drive the price up. So in other words, falling demand for securities drives the interest rate on home loans higher because of this process that goes through. because there's less demand for the main product, which is home loans, which means that the banker is going to issue fewer loans, and those loans that he does issue will become more expensive. Okay? Now, what the Federal Reserve looked at this, good old Uncle Ben, all right, here he is. He looked at this situation and he was very, very worried about it, very worried indeed. And he said to himself, okay, what am I going to do to solve this situation? What I think I'll do is, rather than throwing money at this end of the equation, I'll just buy the securities. So as these buyers drop out, the new buyer, Uncle Ben, okay, steps in. So he's the guy that now buys these securities, gives his money to Fannie and Freddie. And Fannie and Freddie are still, because the market for securities is still strong, because the Fed, Uncle Ben, is buying them, they still need to get home loans. So they're still going back to the bank and saying, it's okay, some investors dropped out, some of these guys dropped out, but Uncle Ben's in there, he's still buying, so we need loans. So go out to your people and issue loans and keep the market strong. So the banker's going out to people like you and I and saying, it's okay, I can make loans, I can sell them off to Fannie and Freddie, so come on, I can make you a loan. And because we've got the supply, therefore, of loans relative to the demand from Americans is pretty much in balance, or maybe there's even more supply, what's that going to do? That's right, it's going to drive the percentage rate on those loans, drive the price of those loans down. Okay, so you can see the way demand for mortgage-backed securities can affect the interest rate on individual home loans. Now what's happening now is that the Federal Reserve has decided not to buy any more of these securities. And the reason for that is because it's seen demand from these investors picking back up recently. In fact, over the last year or so, it's been slowly relinquishing, it's been slowly stopping its sale or its purchases of Fannie and Freddie loans because it's seen other investors step into the gap instead. So demand for these loans, for these bonds, is still strong, which means that the whole system of getting home loans from individual Americans is still strong also. The worry is that with the Fed stepping out now and deciding not to buy loans anymore, the worry is that individual or investors like these who are buyers of these securities won't make up the demand. And the concern is that, with the economy still a little bit rocky, they could drop out at any time. Like this hot money could decide, oh no, we're not going to step in and buy because the economy is too risky and these mortgage-backed securities are too risky. And the danger is, of course, that if that happens, there's going to be less demand for home loans, and then it's obviously going to drive up the interest rate on loans as we discussed. And that, of course, is going to leave all of us, everyone involved in this whole process, very badly, needing a drink.